So I think we've got enough numbers to get underway. So welcome to everyone, and thanks for joining us early on this Thursday morning. Obviously, we'd much rather have everyone in the office and be sharing a coffee and some breakfast with you before we get this underway. But given the lockdown number 5, we're unfortunately unable to do that. But we thought it'd be worthwhile continuing on with our breakfast briefing series by way of webinar this time, and we're very hopeful of having people join us in the office next month. So for the purposes of the webinar, we were wanting to run essentially a panel discussion, and we're hopeful that that will be as interactive as we can make it, given the technology we have available. And we'll go from anywhere between half an hour and 45 minutes, and would encourage anyone in the audience with questions to raise them in the Q&A box, and we'll endeavour to get to those as we go along. And we'll be covering a few different topics this morning, so feel free to throw those questions out there and we'll endeavour to put them to our panellists and get you some answers as we go along. We've obviously, if you were joining us in person, the toilets are out in the lift lobby, but you can probably do that a little bit more easily at home. But given previous experience, let's make sure that our video and sound are turned off when we do go to the bathroom. There's been some horror stories, so yeah, we don't want those again. For those who, most people online will know Aitken Partners. For those who don't know me, I'm a principal lawyer in our Insolvency and Commercial Disputes team. I'm experienced in all aspects of insolvency, as well as general commercial claims for corporate misconduct or shareholder oppression and the like. With me today, I've got 2 senior members of the Jirsch Sutherland team. Jirsch Sutherland are a multi-city insolvency and business recovery practice. Andrew Mattinson is a principal at Jirsch. He's got a broad background in financial services and not-for-profits. He's a registered liquidator and a CPA with a Master of Accounting. He's got a pretty diverse background and skill set. He's got experience in industries from health, not-for-profit, right across RTOs, manufacturing and owners corporations. Malcolm Howell is a partner at Jirsch Sutherland. He's both a registered liquidator and a registered trustee in bankruptcy, so covers both corporate and personal insolvency. He has experience in corporate regulator and as an investigator, and more than 2 decades of experience in both public and private sectors. So we're very privileged to have the 2 of them on the line today. They have incredibly broad experience in restructuring, recovery and insolvency. Joining us very shortly will be Mark Buseman. We'll give him a more detailed introduction once he's on the line, but he'll be joining our panel. He's on the executive leadership team at Spark and heads up their financial planning division. He himself is a certified financial planner with particular expertise in estate planning, aged care and superannuation. So thanks to all the panelists for joining me today. As I think we said in the invitation, we're keen to have a pretty broad ranging discussion. We don't want it to be too much a lecture to you, so feel free to ask questions. I think the best way that we can kick this off and get the conversation going, we've got some serious expertise in the room. So I was wondering if I could impose on Andrew and Malcolm to give us a little bit of background about what they've seen from 2020 and what the insolvency market is looking like at the moment as we go. Obviously, we're past the midway point of 2021 now, still dealing with the repercussions of COVID, and just give us a little bit of background on insolvency in Australia at the moment.
Thanks, Alex. Hopefully you can all hear us. Andrew and myself have been around for a while, so we've seen a lot of peaks and troughs in the insolvency field over our years. This certainly is one of the most challenging times for most businesses that we're talking to at the moment. And I think the legislation that they brought in to try and stop the downward spiral worked to some degree, but we're yet to see the full extent of the carnage, and that comes, I think, after everything calms down. What we thought we might do today is just run through what we've seen in 2020 and 21, where do we think we are now? What do we think is coming? We'll run through some of the common signs of insolvency that we look for, and when we're doing our investigations, and things that people can look for in their own businesses as telltale signs that they need to get some assistance. And then we'll run over briefly some of the different types of administration that we are able to assist people with, and open up for any questions and answers later on. So first of all, obviously we all know that there was JobKeeper came into place. We do have a slide there. Andrew, if you could just pop that first slide up. This slide indicates that the timeline of what's occurred with, and there is a difference in various states, so you'll need to look at those dates. But basically, what we saw was the JobKeeper COVID relief program come in early 2020 and ran right through until December, where there was also the insolvent trading moratorium, and the rules were changed in respect of winding up entities to give companies greater time periods to reply to stat demands. They increased the thresholds for winding up. Stat demands increased from 2,000 to 20,000, so your debt had to be greater than 20,000 in order to do that. Bankruptcy proceedings increased from 5 to 20,000, and of course the time period increased from 21 days up to 6 months. So what that meant for us as insolvency practitioners was that there was basically very few, if any, appointments in the first 6 months of the COVID period, starting in early 2020. Those businesses that would ordinarily have gone into liquidation in the natural attrition that we see every day, obviously have all been quarantined in that period. More recently, we've seen an increase in the stat demands going out, but not a significant increase. But certainly during that early period, 2020 and early 2021, we saw very, very few appointments coming through, and it was only those who had the inclination to come and see us and appoint us voluntarily as either a voluntary administrator or a liquidator that we really were able to help out. And there was also some temporary relief for directors from the insolvent trading provisions, which was greatly received. Obviously, insolvent trading is a big issue when a company goes under, either in a voluntary administration or a liquidation. It's something that leaves the directors exposed personally, so it's a very important aspect of insolvency, and that relief meant that people had time to get their affairs in order, try and work out some arrangements with creditors if they could, and seek whatever relief was available, such as rent relief. Like I say, I think overall, in 2020, these changes to the legislation, they had a positive effect. Certainly from a practitioner point of view, we saw the noticeable decline in our appointments. So definitely they worked in a way that they were intended to work. We then, at the end of the year last year, the moratorium ceased. JobKeeper came to an end at the end of March this year, That's when we expected after March that we would see the onslaught of appointments. Hasn't come through yet. I'm not sure why, but what we will see is people now lodging BASs for businesses, and there are so many businesses that have closed up, but they'll be lodging their BASs now. There'll be all sorts of entitlements, etc., that are outstanding, and I think those tax debts that they already had pre-COVID will now become due and payable, and it's really just waiting now for the tax office to start their enforcement program.
And what have you seen on that front, Malcolm? And have you got much of an indication as to what the tax office are doing at the moment? I mean, we've all probably read the newspapers that say they're shifting their focus to recovery, but I'd be interested to know what your thoughts are on what they're actually doing.
Well, I must say to date, I mean, there are rumours going around that they're going to ramp up the enforcement program, but we haven't seen it. We're not seeing huge volumes of appointments coming from the ATO, if any, and the SRO. So at this point in time, I'd say there's little to no enforcement. You can still enter into repayment arrangements with the ATO. People are making full use of that. But at this point in time, Alex, we just haven't seen that the enforcement program really take effect.
Alex, I did attend a seminar with the debt recovery section of the ATO, who were quite upfront and said every state government department, such as the SRO, ATO, work cover, have been inactive through this COVID affected business period, but they are now looking at those companies that have had a hardcore debt prior to the onslaught of COVID, and will start ramping things up. And I've noticed over the last week that the SRO in WA and Queensland, work cover in Queensland, there's been a couple of applications for winding up submitted by them, and the ATO have advised come September, they've fully resourced their area again in the debt recovery area, because those resources were redeployed to other areas with COVID initiatives going on. So September seems to be the date where they're going to put the spotlight on debt recovery, and I think we're at about $80 billion at the moment. Is that correct?
That's something crazy like that.
There's numbers changing every day on how much the book is at the ATO that they need to recover.
Yeah, thanks for that, Andrew. That's certainly accords with my experience, and realistically at the moment, although there is that threat of future action, at the moment they're really focusing on where there's particular aspects of dishonesty or fraud, or there's a black cross against a particular taxpayer, and if you're not falling within those categories, you are, at least for the moment, avoiding attention. It probably emphasises the need for everyone to, if you do have tax debt, proactively engage with the ATO, because for the moment they are very receptive to that approach. But before I get you to go on, Malcolm, I might just welcome Mark Buseman, who's joined us now. Thanks very much for joining us, Mark. I did give a little spiel of introduction to the group that are online before you joined, but perhaps if you could just give a little bit of your own background and who you are and what you do.
Yeah, sure. Morning, everyone. Apologies, school drop-offs and everything, but thank you for having me. So yes, my name is Mark Buseman. I'm the business leader of the financial planning division at Aspar. So Aspar is a multi-discipline sort of financial services firm that we offer accounting and advisory services, financial planning, insurance broking, and also credit. We have a credit license, so we offer mortgage broking services, both commercial loans and residential loans as well.
Fantastic. And can you give us, I suppose, in short précis, a little bit of summary of what you've experienced over the past 12 months? Obviously, we're a little bit different to the insolvency and restructuring markets, but how have the financial markets been affected? What are you seeing that flowing through onto other economic indicators?
Yeah, certainly. Same as everything, but COVID obviously had a significant impact with financial markets, as we saw effectively 16 months ago when COVID sort of first came in to light. Share markets were very affected across or globally. In particular, our Australian share market, down from its peak in February 2020, was off 37% before it started to recover. So nothing new for share markets. We obviously do go through these corrections from time to time. Similar sort of event was the GFC, where share markets actually reduced by 54%. So the GFC actually was more of an impact on global markets. But the effect really from COVID was how quick the recovery has certainly been. That 37% drop off as well took 20 trading days for the Australian share market to fall that amount. So virtually, if everyone can remember, the sky was falling, everyone was panicking, people were looking to sell. But for those that were able to remain invested and remain in the market, we've actually seen quite a sharp recovery, and actually global markets have recovered not only back to where they were, they've actually kept increasing just with a lot of global stimulus and things such as that.
Yep, fantastic. That's a really nice background. Thanks for that, Mark. I might just handball back to Malcolm and Andrew. We were sort of talking about the ATO's attitude to the, I suppose, insolvency and restructuring triggers. Are there any other things or triggers that you're aware of that have had an effect over the past 6 months, and I suppose potentially have an effect over the next 6 months?
Well, look, this is more generic, I suppose, but obviously businesses have really been hampered with the import-export availability of getting product in. You've had supply chain disruptions. I don't think we've seen the full effect of COVID as yet. As Mark said, there's corrections in markets, but if I'm obviously not an economist, when we've got our share market that's quite buoyant at the moment, we've got unemployment going okay, inflation seems to be under control. How can that be the case when we've had shutdown 5 in Victoria? And we just see so many dormant companies in the city, as you would, Alex. There's hospitality has been probably the biggest industry that's been affected, because they run on an oily rag anyway, and without getting rent relief and any other assistance like JobKeeper, I just don't know what those companies are doing at the moment. I think, Malcolm, you'd agree that there's a lot of companies sitting there that should be in liquidation, but they've run out of cash, they've probably run out of assets. So how do they deal with their shell of the company at the end of the day?
Yeah, I think, Alex, you'll see that the construction industry is starting to have a bit of a slowdown at the moment, and that's because of the supply. They were able to keep trading for a long period of time through COVID, but with no imports coming in, and there's trouble with labour as well. We've seen a decline in the availability of materials in construction. So when construction slows down, it's like the whole country starts to slow down. In Australia, for some reason, we're just relying on it so much, other than mining. Those supply chains are having a drastic effect on a number of businesses. A lot of businesses that come to us have problems getting materials, and like I say, labour hire.
Yeah, and you've gone a long way to answering a question that we had from one of our audience, Sanjay, in hospitality and construction being 2 industries that are particularly under pressure. Are there any other industries that you see that flow-on effect to? Is there a particular bracket of income that you see companies under particular pressure? I mean, are the top end of town struggling, or is it just the SMEs that are experiencing this difficulty at the moment? Can you go away to answering that?
I think it's across the board. There's no particular industry that's hurting more than others. I think you would expect that retail might be significantly impacted, but those that have gone with the times and gone online have actually done well. So they're thriving, but there are the others that are falling over, and that's the same in any industry that we're seeing. they're all the same. You've just got to keep up with the times, I think, and every industry has its own problems. There's no dollar value that I'm seeing. There are some big companies that have gone under in the last 6 to 12 months, but there's also a number of little ones that have closed up. They may not have gone into liquidation yet, but I'm sure it's pending. So I don't think there's any particular dollar value that you can ascribe to it. Every company is at risk.
It's feeling the pinch. Yep, understand.
Yeah.
Thanks, Malcolm.
Yeah.
I mean, obviously, another aspect of businesses and their ongoing viability is the availability of money and finance. Mark, I was wondering if you could give us an insight into what the bank's attitude is at the moment, what their attitude is likely to be over the next 6 months, and whether the impact that interest rates and the like have on that.
Yeah, sure. Look, it's an interesting time, I guess. Record low interest rates, and we have been at this sort of level for quite some time. There's certainly been quite a bit of a switch within the banking industry. Obviously, we've had the Royal Banking Commission as well, and obviously the flow-on effects there. So really, there has been a refocus on what their business models look like. A lot of the banks have obviously exited the financial advice industry, and they're really focusing on their lending activities, really their core activities. That's where they're quite profitable, and the banks look different to the GFC then as well. During the GFC, there was a credit crunch. There wasn't that liquidity in the market. I think, fingers crossed, governments have sort of learnt from that, and actually there is quite a flood of liquidity in the market, lots of stimulus. So banks are certainly still willing to lend to industries, and certain banks still have that risk appetite for certain niches within sort of business. But certainly, look, very, very, very low interest rate environment. Our official cash rate's 10 basis points at the minute. Could we go lower? It's possible, but more than likely at some point interest rates will start to increase. We actually have negative interest rates, obviously, in Europe as well, which we haven't dipped into negative interest rates as yet, but never say never. We don't have a crystal ball. But look, certainly for the banks, their interest rates are still quite low. They have some funding issues potentially. They obviously source a lot of their funding from overseas. So particularly as we start to see that inflationary effect, that flow-on effect of materials and wage costs increasing, potentially interest rates will rise. So now might be a time to look at fixing rates, potentially at quite a low rate. But banks are still willing to lend. Our banks, particularly our Australian banks, are still some of the most capitalised banks in the world. So they still have an appetite to lend.
Fantastic. Thanks, Mark. And Malcolm and Andrew, I suppose from a more distressed debt point of view, are you seeing similar attitude from banks? Are they willing to extend further credit when you're in more of a distressed situation? What's their approach been to businesses that are experiencing sort of immediate cash flow difficulties, but have long-term prospects, but need the support of a bank? And is there a difference between the top tier financiers and then you get into the second and third tier lenders?
I think it's, I don't see banks handing cash out too easily. Cash is cheap if you want to go and get a loan, but the banks make it very difficult to get the money out of them. And I think they're being very cautious. They're certainly not making appointments as usually we would see them making appointments as receivers. But I think they're giving people a lot more leniency. They're letting them go out longer and working with them. We noticed the banks are trying to do a lot of the insolvency work in-house, negotiating with the clients and working it through before they make any appointment. But the bank appointments are next to none in the scheme of things. So whilst Mark will take your point, money's cheap, but trying to get money, I'm not sure whether you've tried lately, but it's very difficult. And for a company in distress, I think the bank's reluctant to hand more cash out.
I think on the flip side, Alex, I think those asset lenders have been quite buoyant. They're lending against plant and machinery, purchase of new trucks. I think that market's been okay. I don't know what their debtor book's going to look like in 12 months, but they're quite active in helping businesses, whether they are refinancing plant and equipment to raise capital for a short-term injection. But having spoken to those, they've got enough activity going on at the moment.
Yeah, debtor finance is a big thing, I think, at the moment. If you've got a good book, a debtor book, that's if you've got one at all, then you may be able to get debtor finance to help you through. Probably easier than an overdraft.
Yeah, I understand.
Yeah.
Sorry, Mark, did you want to jump in there?
Yeah, you're absolutely right. Look, unsecured lending is always a bit tougher for the banks, and obviously more requirements, more hoops to probably jump through versus, say, your secured lending with assets and equipment and finance. Yeah, you probably got a little bit more leniency. So your points are very valid.
Thank you. And
I think, Alex, one of the saving graces is that the property market's been so buoyant, you know, and people have borrowed against their properties, so they've been very lucky that property prices have gone up and not gone down or plateaued. That's meant that the banks have been a little more comfortable with the amount that they've lent, so not making those appointments.
Yeah,
and you've raised that. Sorry, Mark.
So you're correct. Effectively, when COVID first hit, everyone was anticipating property prices to drop 20%, but they've virtually gone the other way.
Yeah. Not sure
Malcolm,
why.
you mentioned the banks resisting the urge to make formal appointments and instead working with businesses. Can you give some insight in your experience as to what that looks like? I mean, how proactive are they in engaging? What are they actually looking for from a business when they come in and say, well, you're in a distressed situation, we're not going to appoint, but you know, what's the next step for them in that scenario when they're looking at a business?
Yeah, I think they're always looking for, well, first of all, cash flow. They can find cash anywhere, they'll grab that, but they then look to make sure their security is tight and it's good value. So if you've got additional security available, then they'll certainly give you a good look in and help you through the hard times. They want to see a plan. We often see banks where people come to us and it's clear that the bank just doesn't want to bank that client anymore, and they push them out to go and look for another bank to fund them. Not seeing that so much at the moment since COVID hit. I think the banks have just they're a bit shell-shocked after the Royal Commission, a bit nervous about doing too much and pulling the trigger on too many people. So it's a great time to go to your bank and negotiate with them, or at least work with them to try and get their support in a restructure if you need to do a restructure. Well, I think the banks are bending over backwards to try and make sure that they don't become that nasty industry again they were some time ago.
Yeah, I understand. And so to extend that out, I mean, from the point of view of the owners and directors of these businesses, what should they be looking for at the moment? I mean, cash flow is always going to be a key aspect. Can you give some insight into other things that a director should be thinking of, and even some practical advice about what they should be doing at this point in time?
Yeah, look, there's some real key indicators of companies in trouble. Most business owners would see them, but not necessarily recognise them or deal with them if they do recognise them. So obviously the obvious ones are your poor cash flow, if you're unable to pay your bills on time, you're not paying staff or their entitlements. Particularly we see superannuation still being one of the biggest debts that doesn't get paid. Obviously there's statutory debts, ATO debts. Once we see those start to rack up, I mean, business owners should realise that we've got a problem. We should be able to pay these debts on time. If we can't, then we're doing something wrong and we need to go and seek some help. Go back to your accountant, or come and see someone like ourselves or even yourself, Alex, and talk about it, and try and work something out early. You may be able to get out of this with a restructure, and move on and still keep your business and, more importantly, your personal assets. Because we see so many businesses where the personal assets are tied into the business. And as a bankruptcy trustee, that's a very common event where people go into bankruptcy after the business has failed. So look at your net asset position. Obviously, if you're losing clients, whether it be because you can't supply materials or you haven't got the labour to do the work, or you just can't afford to put the labour on, then there's a problem, and you can't run a business without clients. So we see a lot of businesses that are going to go broke, that have these common traits. They've got high staff turnover, they've got high levels of bad debt. Construction industry, invariably we see rework, so you see more maintenance, more money getting spent on the maintenance team than you've got on the construction team. It's very common when businesses are going bad that they're doing poor workmanship, and that leads to problems. The other big indicator is your access to finance. Sometimes you've exhausted all your personal finances. You've got nothing left in your own bank to put into the business except your time. You have no ability to go and get debtor finance, get trade finance or equipment finance. And they're the sort of the three key things. If you can't get bank finance, you need to be able to get those things, help you through these hard times. If you can't do that, then it's inevitable that the business is going to have to be either restructured or it's probably staring down the barrel of some form of insolvency.
Indeed, and certainly what I see, which I'm sure is replicated for you on the front end insolvency, Malcolm, is that you get businesses that probably know that they need to spend some money on some restructuring advice of whatever sort. And unfortunately, it is expensive, and it is an immediate expense, but often well worth it, given that if you ignore it, in 3 or 6 months' time, you're faced with a much more difficult situation, and with lower prospects of actually getting your way out of it. So certainly I've seen, you give some initial advice and say, what you need to do is this, but it will cost you this amount of money. And they ignore it for the moment and come back to you in 3 or 4 months' time. And unfortunately, then the advice is slightly different. So it is about being proactive and addressing those issues as and when they arise.
That's right, yeah. And I mean, if you're inclined to do it, it costs you nothing to pick up the phone and ring someone like Andrew and myself and my team in Jirsch. And there's other insolvency practitioners as well, but we're all out there to try and make sure these businesses survive. We're not here to bury them, so we're happy to spend 10 or 15 minutes on the phone just hearing the story quickly and telling you whether there's something that we can or can't do. And very quickly we can pick up on the problems and often give you some options. And then it's up to the individuals to take those options and put them into practice.
And it's just about knowing what those options are sometimes. So,
That's right.
Yeah, thanks for that, Malcolm.
Yeah.
Just to move back to you, Mark, I was wondering from your point of view and dealing with your clients at the moment, and we don't have a crystal ball, but to some extent you have to be advising your clients about what the future might hold. What are you seeing at the moment? What are you advising your clients at the moment, without going into too much detail and giving away all your secrets? But can you give some insights?
Look, I guess our investment philosophy is more longer term investments and diversification, and just making sure that we are allocating investments in line with our clients' risk profiles. And what we are sort of seeing, obviously, performance post-COVID has been very, very good. I don't know if you're seeing sort of some of your super returns and things. I mean, obviously returns are upwards of almost 20% over the last 12 months, obviously off a very, very low base from COVID. But look, certainly there are some headwinds still for obviously financial markets and things. So I don't think the good times are going to continue forever. But look, we're optimistic or cautiously optimistic that there is so much stimulus around, not only from our Australian budget. $3 trillion worth of US stimulus has been announced by Biden. There's further infrastructure spending there potentially as well. You've got the UK Brexit sort of coming off that area as well. So there is still some good opportunities for growth, although it probably in a lower growth environment, but there's certainly still some very good investment opportunities out there. Typically what happens in these downturns, unfortunately, like we touched on, your small or medium type of entities may disappear, but you typically find your bigger companies get bigger during these periods. Everyone switched there. You look at when we were in lockdown and things, we couldn't go out to retail shops. Everyone switched to online shopping and things. So you typically find your Amazons, you look at technology, healthcare companies have obviously performed very well throughout this period as well. So they're sort of some key elements that we look at really for our clients. And I guess Australia as still only represents about 2% of the overall global market. So there really is 98% of returns, particularly overseas. That's where a lot of investment opportunities really do lie for our investors.
And you touched a little bit on the fact that those tech and online retailing businesses have done particularly well over the last 12 months. Do you see those trends coming off a little bit if we do, get back to COVID normal, to use an overused expression, or do you see that trend continuing?
Look, it is. Look, those are probably still some headwinds. Are we out of it? Look at financial markets are very forward-looking, I guess. So from that point of view, we have really seen that V-shaped recovery that people have talked about. There was speculation it could be a W-shaped recovery and things like that. But look, there still are headwinds. You look, we're still in lockdown in various states as well versus other places around the world are getting back to some sort of normality. But I guess it's really focused on vaccines, efficacies. Are there new mutant strains of the virus again? Is this the new normal? We don't really know. But certainly, look, I think there are still opportunities for growth, but it's probably being in those right areas. You look at another sort of sector that was probably very impacted has been travel and airlines and things, but certainly there has been rescue packages there because they are industries that need to be saved. People will want to travel once we're able to get through this. So there is sort of a shift from sort of those growth companies into value companies that have probably been impacted further from COVID. So there is some opportunities there. Growth companies as well, particularly technology, was sold off probably late last year due to the risk of sort of interest rates increasing and inflation, as we're probably seeing. So US inflation numbers have come out and they are quite high. We probably still have an opinion that is still quite transitory just because of the stimulus coming through. A lot of the inflation numbers were in increases in used cars and housing costs and things such as that, but we feel that will settle down over time. But that's obviously then impacted the bond market. So higher yield, higher interest rates means capital prices have to reduce, and that's what we've sort of seen there. So inflation and interest rates will obviously come at some point, and that obviously impacts growth and technology companies. It's more expensive for them to repay debt. It's more difficult for them to grow. So that's probably some of the themes that we are seeing in the markets.
And the international investment in Australia obviously has been a big driver in the past. I mean, has that slowed? Will it pick up again once there is that more movement between countries once the travel is allowed? Is that something you can give an insight into?
Probably, I guess it's still, globalization. There is still investment, overseas investment into typical companies and things. Look, our exchange rate as well obviously has an impact there from that point of view, but it's nothing that we've seen drop off of. Our Australian companies are still performing quite well. I think Rio announced their numbers during the week, obviously helped by iron ore prices. Look, Apple announced their numbers during the week as well. Significant sort of revenue numbers. There is a lot of cash out there for future sort of M&A activities as well. Interesting.
Thanks very much for that, Mark. Malcolm and Andrew, I mean, I've just asked Mark to look into the crystal ball a little bit and into the future. Can I ask you to do likewise, obviously in your industry with restructuring and insolvency that touches on the finance and things we've discussed? Can you give your expert opinion as to what the next 6 or 9 months holds for Victoria in particular, I suppose, and to the extent relevant, Australia at large?
Well, Alex, I've been incorrect so far. We all expected a tsunami of work to flow through the insolvency sector, but that hasn't happened. I think there's a lot of, as I mentioned before, dormant companies that can't do anything. And there's no restructuring plan that can be in place or put into place for these entities that have already stopped trading and handed the keys back to the landlord some months ago, potentially. I see that I haven't seen any figures yet, but Victoria itself is always been prided about the education space and what quality education we provide. But with the lack of imports of overseas students, the registered training organisations and the universities, that they must be bleeding at the moment, because that's where the big margin was in the education space. So I feel that there's going to be a fallout from in the education space. I think construction that has a high activity anyway in the insolvency space, because it's such a large industry, from the sole trader right through to the national firms. I still think there'll be activity there, but hopefully, now that we've gone through lockdown 5 and seem to have got it under control, that maybe we move to more activity going on in the space. I don't really know. I don't have an opinion now. Having seen what's transpired in the last 15 months, I really don't know where the insolvency space is going to go. But look, I think the biggest message to any director out there is to, as you mentioned, be proactive. Don't get to a state where you've got no options, where you've run out of cash, where your debtors aren't paying you and you can't pay your creditors. Just try to find these warning signs as quickly as you can, so that there's some options available to the company before we end up into what we call a dead duck scenario.
Yep. Absolutely. And I probably should have put the disclaimer on before asking about your future predictions. We won't hold you to these. We understand it's difficult at the moment. I must admit, I went to a presentation in March or April last year with one of the most senior economists in Australia, giving his view about what was going to happen, and he was completely wrong. So if he gets it wrong, I think we're allowed to give our best guess, but appreciate that part of the reality at the moment is that it is uncertain, and that it's difficult to predict what's going to happen. And the one thing that holds true throughout it all is just that you need to be proactive and keeping a close eye on everything that's happening, whether it is your own business or whether it is investments, and take into account the changing headwinds.
I think also, Alex, that the directors don't know the space, so it's hard to tip your toe in, or it's quite confronting to a director of a company to, well, what do I do now? Where do I turn? But our advice is to go to see your solicitor or your accountant, who then can give you some guidelines. I mean, insolvency is quite a specific area, and I just don't think out in the community that there's enough education for directors to understand, where do I turn next when I need to get some advice. But our advice is, as I just said, to either pick up the phone and speak to us, as like Malcolm said, we're happy to talk on the phone, or go see your accountant or your solicitor to try to understand what your position is.
Yeah, Alex, I mean, the legislation's there, and it's proven that it's there and it works. But there are options available to people, business owners, in their circumstances, both in their personal positions and in the company sense. So those options, they vary from your voluntary administration process, where you might enter into a deed of company arrangement and pay your creditors out so many cents in the dollar and retain the company and trade it on, which is a really good aspect, and an outcome. And otherwise, you've got your liquidation processes, and personal bankruptcy is exactly the same. You have options to enter into compositions, or go bankrupt. And it depends on the circumstances as to which one suits which company or individual. Early intervention is the key to it, I think. And we've seen the government introducing various measures of stimulus to try and help people through these times. Only last night I was sort of surfing around on the web and went onto the coronavirus site, and actually there's quite a good summary about what is available for both personal and businesses. So it's, do your research, get around, do your research, speak to your accountant. If you need to, give us a call, have a chat to us. Always interested to hear what industries are hurting, and see if we can help them out. So there's options available, and certainly through insolvency, but otherwise through the government incentives. You've got to do your research and get out there and have a look.
And indeed, there's often a negative sentiment associated with insolvency in particular, and restructuring and insolvency sort of gets lumped in together. But what is forgotten is that the sooner you go and get some advice, that the better your options are to either keep the business alive, or indeed to come up with an option that might be formal insolvency but allows you to continue in some form into the future. So that stigma associated with it is often overemphasized, and it comes back to your point about knowing your options.
Yeah, that's right.
Thanks, guys. That's been a really fantastic discussion. Just wondered if there's any thoughts, I suppose throwing back to you first, Mark, as to any final thoughts that you'd like to leave our client base with that have joined us this morning.
Not overly, no. Thank you very much for your time and allowing us to present and provide our thoughts. But look, we're in for some uncertain times. I think there is no real precedence for this apart from the 100 years ago with the Spanish flu type of scenario. But yeah, governments seem willing to spend and have stimulus to try and get through this, which they've sort of learnt from the GFC when they weren't willing to do a lot of that. So fingers crossed we're sort of through that now. But yeah, by all means, yeah, seek different packages if you're entitled to try and get through this period, and we'll try and grow from there.
Amazing. Thanks, Mark. And yeah, thank you very much for taking the time out of your morning to join us and share some of your thoughts. It's been really helpful.
Thank you.
Malcolm, Andrew, is there any final thoughts that you'd like to leave us with that we haven't touched on?
I actually wouldn't mind asking Mark a question while he's got his crystal ball out. I'm intrigued that the property market's so buoyant, and I just don't understand what's driving that, because we've lost the overseas investors, with particularly the Chinese investment that was really, really big. We're slowing down on construction. That may have an effect, but what else do you see is driving that property market?
Yeah, it's interesting. Look, location, the old principle sort of there, but it's also, you look at the official cash rate is 10 basis points in Australia. It's hardly worth keeping money in the bank for that low interest rate. It's almost, you've got to put it in something, to put it into property, to put it into shares, to earn something there. So I guess it still is that a great Australian dream. People love property within Australia. It's something physical, you can see it, you can touch it, and it can provide a return from that point of view. So yeah, it certainly has gone the other way. Certainly the lack of international incoming or inbound people has sort of impacted there, but yeah, it has continued to increase. People that are borrowing or gearing up to their eyeballs, once the property prices reduce a little bit, that might be the time that comes that the provision for bad and doubtful debts may increase, but that's something that we watch within the banks, and certainly through COVID, those bad and doubtful debt provisions within the banks were certainly very high, but certainly they've come off from that point of view. Even people that were on repayment pauses still were able to make repayments towards those loan payments. So yeah, the property prices continue to increase.
Yeah. As far as the future goes, Alex, I think from my point of view, I just would like to leave people with the message that you need to do your homework about your own particular circumstances and businesses. There are options out there for you. There's always an option. Some of my bankrupts are the happiest people in the world. They've saved their marriages. They've kept the property in the family, and they've gone on and they're starting new businesses. And I still keep in touch with some of those people. So the options that are out there are for the good of everybody. So make sure you use them.
Yep, fantastic. Thanks, Malcolm. And that is a really great message to send out to people. That, as I said, puts paid to some of that negative sentiment. There are positive outcomes from those sorts of personal insolvencies and corporate insolvencies.
Yeah.
Fantastic. Oh, well, thank you both very much. Thank you to everyone online who joined us. We will send around some material from both Malcolm and Mark with their details, and obviously feel free to reach out to either of them or myself with any further questions. We're happy to have follow-up questions after the event. I don't think we have any more questions on the online Q&A. So absent anything else, thank you very much for your time, and we'll be in touch.
Thanks.
Thanks.
Thank you.
Thank you.
Thank you.